Hey everybody, it's Dave. I'm back with an addendum on RoboAdvisor because it makes me angry that people don't understand what Robo is really about academically. So let's look at it a little deeper. Stay with me on this. I want to introduce you to somebody. This is Alex Majonek. He is actually been working in advisory and robo-advisory before, and he knows his stuff. So come on over. I want to show you guys something.
Hi guys.
Say hi.
Hi guys.
So he was just visiting us today to look at some stuff. I want to show you something that's just a diagram that not many bankers like to talk about, but this is the basic facts in banking. Okay? What you have is three pieces, mainly in the wealth management from affluent up to high net worth spaces. You have what's called discretionary services. I'll make it with a big D. Discretionary is where the bank does basically everything for you. So it replicates the portfolio, it trades it down strategically, it rebalances it, it does tax optimization, the whole process for you. So it's like autopilot. It's the Tesla of the future, right? And that business is usually, let's say, this much of a bank's asset under management. Any private bank has this basic thing going on. The second big piece is usually advisory, what people call advisory. So they're really working with a client and establishing not just the relationship, but the two-way dialogue around what the client likes to hold from a preferences perspective, what he's held in the past, so what he takes from other banks with him, etc. This advisory piece of the assets under management are usually quite a large piece of what the bank is doing. And then there's a third piece, which I'll make a T, which is just one-way transactions from the client towards the bank. So this is where the bank is just being basically a commodity. So it's providing the transaction execution and after-trade support for a client, but this can also be well into the big clients, so the high net worth space. So the richer you are, the more own bankers you have in your own what's called a family office, and these people take care of things, and a lot of the time they just decide on their own transactions. Okay? So what we basically wanted to cover is, what is robo-advisory? It's this. It's a corner of the most automated piece, or automatable piece. It's the low-hanging fruit in the industry right now, and that's why robo-advisory can exist comfortably, because this automated portfolio replication stuff done with less quality. So a big bank may have thousands of instruments on the shelf. It may have a really strong instrument selection process, a really own view on the markets and asset classes, and it can do this really sustainably for a long time and be straight on market. And what the robos have done in a lot of cases is just done a lower version of that, which with less of a technology and process piece behind it, and they can replicate some of the portfolio stuff. So really, robo-advisory is here. So why do we call it robo-advisory? It's not really robotic, and it's not really advisory. So the thing with robo-advisory is it's not where the most of client assets are, it's not really advisory, and it's not fully automated and robotic. That's why I have personally a problem with the term robo-advisory, but you have a different view on robo in that sense?
Well, yeah, in my opinion, robo-advisory today is just mostly like doing portfolio allocation stuff, like customer profiling and finding out which products fit to the specific customer. But you're right, the whole advisory thing, in my opinion, is still a human being work. So you cannot substitute with a robo to do that, because most of the parts of the advisory process is like I talk to my advisor, he gives me certain information based on my profile. I mean, he can take the profiling from his robo, basically. So the robo can do the simple profiling, but at least I need the advisor to make the final fit, to give me the feeling of confidence, to make me stay in the assets, because most of the robo-advisors you find in the market, you get your money right back tomorrow. You can just say, I quit the service, I take my money out of this, and I'm out. I go to another real advisor or another robo-advisor. So if you want to have like your customers using your products for longer than, I don't know, 1 year, you need to have like a human being just making sure that the guy is not going crazy when the market collapses. Mm-hmm. So which of these robo-advisors just made it through one of the crises we had recently? I don't know if there was anyone.
And this is the great debate. We're happy to take your comments about this. I know there's two sides to the camp on this, but usually I try to play the middle ground and understand both sides. And I think the perspective you just gave, Alex, which is in a lot of cases, once you have affluent or above wealth, you really do want that human contact is actually still true, and it proves itself out in the metrics and the tractions that the robos have generated. I have a ton of respect for them, as I'm sure you do, but kind of waiting for the business model to prove out.
Yeah.
Last thoughts on that? Business model proving out, traction in robos, have you seen it?
Well, I think there will be a business model coming up within the next 1 or 2 years, I guess.
Yeah.
But in my opinion, it is always an approach of humans and robots. It's not the robots taking over, it's the humans and the robots, in my opinion.
Yeah. So there we are, humans and robos. I hope that helped understand robo a little bit better from a banking strategy perspective. Sorry, but it needed a little bit more of a deep dive from what we did this morning in our fourth episode. Thanks a lot for watching.